If you own property in California, you really need to listen up. There's a major, and I mean major, time-sensitive change coming down the pike that could totally alter your family's inheritance. We're talking about a massive tax cliff set for 2026, and you need to know what it means for you before it's too late.
So let's just cut right to the chase. Here's the big question. Could the home you've worked so hard for, the center of your family's life, end up creating a surprise and, frankly, a huge tax bill for your kids or loved ones? For a lot of Californians, the answer is about to flip from a comfortable no way to a pretty startling yes.
Now, to be crystal clear, this is not some new tax coming out of Sacramento. California doesn't even have a state estate tax. The issue we're talking about today is happening at the federal level, and believe me, it comes with a very firm deadline.
Okay, this timeline right here gets to the absolute heart of the matter. Right now, in 2025, we're enjoying a really high federal estate tax exemption, but key parts of the 2017 Tax Cuts and Jobs Act are set to expire. And on January 1st, 2026, boom, the amount you can pass on tax-free gets slashed, pretty much in half.
And wow, the numbers really tell the story, don't they? Right now, an individual can pass on almost $14 million completely tax-free. But come 2026, that safety net is projected to drop all the way down to around $7 million. All of a sudden, a whole lot of estates are going to find themselves way over that line.
So, what happens if your estate's value pops over that new lower limit? Well, the federal government swoops in and takes a whopping 40% tax on every single dollar above that exemption. Think about that. That can create a massive tax bill that just didn't exist for many families before.
All right, you might be thinking, okay, it's a federal law, so why the big focus on California? And that's a fair question. The answer, as you can probably guess, has everything to do with our state's, let's call it a unique real estate market. It puts residents here at a very specific risk. Here's the deal in California. Our property values are so high that just owning a home can easily push a family's total estate over that new $7 million threshold. This means families who have never, ever had to think about estate taxes are now smack dab in the line of fire. And what's worse, their heirs could get slammed with a double tax hit. First, paying that 40% estate tax, and then, if they ever sell the property, they'd also have to pay capital gains tax. It's a brutal 1-2 punch.
Okay, I know that all sounds pretty grim, but here's the good news. There's an incredibly powerful strategy that can turn this looming tax nightmare into a genuine opportunity, not just for your finances, but for your family and your community too.
The solution is something called strategic philanthropy. Specifically, we're talking about donating appreciated property to a qualified nonprofit before this tax law changes. And let me be clear, this isn't just about being charitable, it's about being incredibly smart with your financial planning.
So, what in the world is appreciated property? It's really simple. It's just an asset, like your house or maybe some stocks, that's worth more today than it was when you first got it. For pretty much anyone who's owned a home in California for a number of years, yep, that definition fits your house perfectly.
And you know, the best part is that the process itself can be really straightforward. It's as simple as this. 1, you find a nonprofit you believe in and partner with them. 2, you work together to transfer the property. And 3, you get to receive major tax benefits and create a lasting legacy. It's a clear, totally manageable path.
Now, this strategy, it's about so much more than just saving money on taxes. It's what I like to call a triple win. It creates amazing outcomes for your estate, for your heirs, and for the causes you truly care about.
Okay, let's talk about win number 1, the money. By donating the property, you could completely avoid the capital gains taxes your heirs would have to pay. It also takes a huge asset off your books, shrinking your total estate value, maybe even dropping it below that new federal limit and wiping out that 40% estate tax entirely. And on top of all that, you might even get an income tax deduction right now. It's a huge financial win. So win number 2 is all about peace of mind for your family. You're simplifying things for them, you're easing the administrative and legal headaches during what's already a tough time. And win number 3? Well, that's your legacy. You get to turn your property, your home, into a powerful force for good, funding a mission you truly believe in. So, with all these potential benefits on the table, the next logical question is, what do I do now? And the key takeaway here, the most important thing to remember, is that the clock is ticking. Proactive planning is absolutely essential. You know, there's a quote that just says it all. Philanthropy is a smart part of modern estate planning.
It's not some afterthought you tack on at the end. In today's world, it is a core, strategic piece of a really strong financial plan.
All right, so here's your action plan. It's simple. First, you have to burn this into your brain that January 1, 2026 deadline is not moving. To get the most benefit, you've got to make these moves before the end of 2025, which means the single most important thing you can do is start the conversation today with your estate planning advisor and with nonprofits that can help guide you.
And really, that brings us to the final thought. The deadline is set in stone. The tax world is about to change in a big way for a lot of people in California. And the only question left to ask is, will you be prepared?